Here. Hope you're doing well. We're going to do some more training today, a little bit of education around, yeah, the idea of gentrification. So we're going to talk about gentrification concepts, why property markets transform. Transformation is going to be today's little education piece. So thank you for tuning in. Lunchtime on a Friday. And a couple of people sort of dialing in, which is pretty cool. So we're going to spend about 10 minutes today going through a property strategy, which I love. One which is known as transformation or gentrification. So, yeah, Friday beers, says Ben. I agree. I can't wait to, have one tonight. All right, so let's kick it off. We're gonna talk about gentrification, what that ultimately means for property investors, and how you can kind of understand it as a strategy and see if it's really right for what you're trying to achieve, perhaps from your property investment activity. I think the first thing that we need to comprehend when it comes to understanding gentrification and how the influences of activity work is firstly the idea of market growth and the idea of market. Hopefully this is what's happened to my pen. There we go. What's wrong with you, pen? Market share. So two very different things, to be honest with you, market growth and market share. Market share is really important with the idea of buying real estate for gentrification, because as time passes, a suburb becomes more appealing if it's going through gentrification. The market share of less appealing properties disappears as the market gentrifies, and that is the idea of the gentry coming to town. So it's quite important that if you are looking for eyeballs and equity from doing a gentrification strategy, that you understand the market share, and that the end of the day, you're either going to buy something old and have to renovate for the gentry, or you can design something nice from the beginning, and the gentry will no doubt discover it because it will still be appealing. Market growth, we'll talk about how that works, but the first real lesson when understanding how gentrification ultimately unfolds is market share. You've got to understand that the gentry is completely different to the day you buy where there is no gentry. So your market share will change. If you buy something which is unappealing, by the time the gentry get there, then they're not going to find it appealing at all. So that's kind of the first lesson. Second lesson, I think, when it comes to understanding the concept of gentrification, is the concept of time itself in the marketplace. Now, I like to teach time in real years, because if I said to you, what is long-term investing? Your answer may be different to the next person. So I might say, let's do a long-term property strategy. And you'll be like, yeah, 6 years. And I'm talking 20 and you're talking 6, because I'm using the language long term. So I want to be really clear how gentrification works and where it ultimately sits in time. So long term is 21 years plus. Medium term is 13 to 20 years. Short term is 1 to 12 years, and trading is 1 year. So, as you can imagine, a lot of people also tinker with real estate, and the tinkerers or speculators generally go from sort of 1 to 6 years. If the asset hasn't done what they want in 1 to 6 years, they tap out of the real estate marketplace. You see that a lot. The average hold for an investor is kind of like less than 6 years because real estate can be a little bit slow to do a cycle. Now, remember, ultimately, if you're buying, a $500,000 property and you want it to become 1 million, that's a big journey. It has to do 100% to be ultimately, do its thing, right? So how it works is medium term is generally what I coach because you'll get anywhere from a 13 to 18-year property cycle, meaning you should get the result of this from your medium term. The cool thing though, if you buy the right property, it will actually transfer to the next property cycle. And that's why we like long-term investing, because you can take an asset and buy it for a medium term kind of dynamic, but also go for another cycle. This is again where, how many cycles are you going to be investing for? The reality is a lot of people would like to hold assets for a very, very long time. So there's 8 stages to gentrification, and they relate to a medium-term strategy. 8 stages. So when we break down the stages, they're kind of best broken down into 4 quadrants. And each 4 quadrant is that one. Each 4 quadrant has the opportunity to get a little bit of growth along this journey for 15 years. And that's why people like gentrification suburbs, is because they transform in sort of little groupings, if you like, which is what it's all about. So the first grouping is really the idea of broken windows and policy. This is when you go to a suburb and it's pretty derelict. It's not the nicest place. It's sometimes known as broken window theory. The reality is the neighborhood is not where wealthy people want to live, but it may be considered a bit of an up-and-comer, a bit of an ugly duckling. Usually the telltale sign is location. In other words, it's just too good a location or distance from something incredible to be worth what it's worth. The second sort of part of the puzzle, or the top part of the puzzle we might go to, is known as turbo gentrification. This is where like the gentry, the wealthy, buy real estate in the suburb and pay a lot for it. Rich people will pay for nice real estate. They don't need to buy problems like a broken window real estate marketplace. Once full transformation has happened, really wealthy people will, all want the asset, and it will be considered cool, the place to be. It will be considered, a nice suburb to own real estate. Social status around the suburb will be very, very strong. Along the journey, though, you get, for example, displacement and population shift. This is ultimately when prices start to move. People who are typically from the neighborhood, so to speak, really can't even afford to live in the neighborhood. Things start to become a little bit beyond their means to stay. So they eventually kind of get out of the marketplace, or, for example, they can't keep up with the rent or the cost of rent in the suburb. So they ultimately leave. Around here is what we sort of talk about: intensive investment, pioneering investment. this is kind of when policy makers and people start to go, you know what? It's a pretty good suburb. Why don't I go renovate, or why don't I buy a house or knock it down and rebuild, that kind of thing. So you start to get this kind of effect along this journey of different stages of the process. Now, the reality is, if you generally get pay the most for a turbo gentrified suburb. But that doesn't actually mean the suburb's not going to increase in value. If anything, a gentrifying or turbo gentrified suburb, you might pay $1 million for the asset, but because it's a wealthy suburb, 10% growth is not a problem. 1.1 is not a problem for that market. So you're just constantly getting some pretty good growth. What you'll find down here is, rather than paying $1 million, because the suburb itself is not as nice at this point in time, and the social status of the suburb is not as well received, then you might be paying $600,000 or $500,000 for a similar asset. And again, it's not to say that the top is any better than the bottom. The reality is, if you've got less of a budget, you're probably going to have to go deeper before the transformation has happened. When suburbs are fully transformed, they can be absolute capital growth hotspots because so many people want them. Before they're transformed, you're buying the problem of before they're transformed. And that is why I find that this journey of around 15 years is perfect for gentrification as a location property tactic. Because when you go back to following the principle of time in the market, you're going to get some equity opportunities as the stages unfold with gentrification, but it will mirror its own sort of process. It will follow a medium-term cycle. But the great thing is, when it's completely gentrified, it doesn't die. Like, it doesn't stop growing. It actually rolls over to the next cycle. And that's one of the best things about gentrification, is once you get to a price where it's worth a lot of money, it doesn't stop, because wealthy people will pay more, and there's more money at the top of the funnel in Australia than fundamentally the bottom. The reality is, if you look at how Australia is, there is no actual middle class in Australia anymore. It's kind of wealthier people, or kind of like poorer people. And the middle class is quite a small group these days. So the gentry, or buying for the gentry, is a really good idea. The trick to it, and where I've certainly been burnt before, is making sure market share. You've got to design something for the pursuant people who are coming to the neighborhood. You don't want to hold something that basically the displaced will own. That's the concept of gentrification. Anyway, hope that was interesting. Thanks very much for your time. Have a lovely weekend, whatever you get up to. Bye.